You are listening to ChartingWealth.com's weekly review and forecast for the week beginning January the 4th, 2016. Happy New Year. We were gone for a couple of weeks on a wonderful vacation hiatus. We are supercharged and ready to jump right back into things. And where do we begin? Well, as always, we start with IYY. What is that? That's a total market index fund. It's an exchange traded fund that tracks what's going on in the whole market. And what's going on in the whole market? Well, the market's been sliding sideways for quite a while. We don't have a whole lot of movement when we look at it. It tried to cross over going down on the weekly chart back on the 18th of December, and it looks like it's trying to cross back over going down as far as the MACD, the moving average convergence divergence indicator. The derivative oscillator has already rotated over going back down. We look at the week of the 18th, a lot of down movement then, the week ending then, the week of the 24th. Some up movement, again, still within the candle of the 18th, and we saw the same thing the week ending on the 31st of December. Saw the same kind of thing occur where the market attempted to move up, but again, that entire movement was contained within the down candle back on the 18th. We're getting into a new year. We'll sort of see how things start, but looks like the market's trying to cross over going down. If the derivative oscillator is any indicator, we do have a converging on the MACD, but that's not occurred yet. Now, what happened over the past week, the last week of the year? Well, we saw the market tick up on the 28th. Down a little bit on the 28th, actually up on the 29th, some down movement on the 30th, and then some real down movement, basically taking away all the gains earlier in the week on the 31st. So again, we are in a confirmed up move on the shorter chart, the one-day chart, and we're still technically in a confirmed up move on the weekly chart. It's not yet crossed over going down, and who knows, it may not. We're going into a new year. Beautiful thing about reading the charts is we use the charts to tell us what to do, and if the charts haven't told us what to do, the beautiful thing about not being a professional trader is we don't have to trade. We can sit here and wait and watch, and when we get signals that say buy, 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 we buy. Again, in our virtual accounts, we're not a stock calling service. We don't give stock advice. We're an education company, but in your virtual account, buy, 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 buy. If the markets are telling us, the charts are telling us to sell, we sell and go away and wait for another day when the charts tell us what to do right. So we've looked at what's going on the weekly chart on IYY, the total market. Next up is SPY. What is that? Well, that's the Standard & Poor's 500, another exchange traded fund that tracks that. It's getting very close to trying to cross over going down at the end of the week. And again, we had a big down week on the 11th, a much bigger down week on the 18th of December, and then sliding sideways those last 2 weeks of the year. Derivative oscillator is down, like on the IYY, the total market on the S&P 500. If we go and look at the 4-hour, we don't need to go to the 4-hour chart. We want to go to the daily chart. I'm reverting back to my daily broadcast. What do we see going on? Well, we see on the 24th a crossing over going up, and that was on the Friday before, that was the last trading day before Christmas. Then again on the 28th, we saw the market open with a little bit of give and take each way, a drive up on the 29th, and then started some down movement, which totally absorbed the drive up by the end of the week, ending down. However, we don't have a crossover yet going down, so technically, just like the total market, the daily chart is still in a confirmed up move, as is the weekly chart. Getting close, though, on the SPY, or the S&P 500. Now, lastly, as far as our indexes go, before we get to gold, we'll look at the Qs. What is the Qs? Well, the Qs is the NASDAQ 100. What do we see going on here? Well, it looks like it's technically crossed over going down, even though we had some up movement for the week ending the 31st as far as price movement goes. But Again, what's so beautiful about the MACD, the moving average convergence divergence indicator, is it helps look through some of the clutter that you can have with price movement and gives you a good idea of what's really going on with internally with the entire index that you're looking at. We can see derivative oscillators pushed over into the red, and we'll continue to monitor what's actually happening with the Qs. We've got upward price movement as far as that candle goes for the whole week. However, of course, on Friday, the market was down. The Qs was down 1.24%. It was the biggest down on those three indexes that we look at, the total market, the S&P, and the QQQ. If we revert back to our daily chart, what do we see going on? Well, that big down move we talked about tried to almost erased all the up move from the entire last trading week of the year as far as the Qs go. However, the Qs is still in technically an up movement on the daily chart, and it is in a crossover going down on that weekly chart. Now, that's where we are as far as our indexes go. Let's take a look lastly at where gold is. Gold crossed over going down on the week ending, actually started going down significantly the week ending on the 6th of November, really started its acceleration down on the 13th, continued to move down until about of the 27th of November, and then has pretty much slidden sideways since then. We put in a purple line around, 101, something along those lines, and we are continuing to monitor that movement as far as where gold is going to bottom out and if it's going to bounce off that bottom at some point or if it's going to continue to move below that, although that's sort of the lowest of the low that we've seen in a long time on gold. Seems to not be going below that. So when we get some good confirmed up movements on gold, maybe we'll see gold be something that we want to look at potentially buying in our virtual accounts. Now, if we go back to the daily chart, what do we see going on? Well, the daily has been sliding sideways, some down movement on the 30th, and then an attempt to make some up movement, 0.04%. Now, again, 0.4% is not a lot of movement, particularly with the movement down the day before, starting off the week actually with a down move. Gold, again, is perhaps going to touch that low again and maybe start moving up, but until we get some charts telling us what's going on, gold is still in a confirmed down move on our long-term chart. Now, we've talked about our indexes. Let's do the one thing that we only do once a week, and we always look at our charts every day on our daily forecast and review, but we only do this once a week. And what is it? Well, we look at what happened over the last week news-wise, and we look at what might be affecting movements in the market over the next week. How did we end up the year? Well, our U.S. third quarter GDP was revised lower to 2%. We saw that the UK's GDP slowed. We saw U.S. existing home sales plunge. U.S. consumer sentiment, along with income and spending, rose. China continues to make adjustments to its 2016 blueprint. As we sort of delve a little deeper into what happened to U.S. GDP, it was revised down to 2.0%. Our economy grew at a revised annual rate of 2% in the third quarter, and that was down a little bit from the 2.1 in the prior quarter and down from 3.9 in the second quarter. Consumer spending is what gave us the strength with allegedly healthier jobs market and lower fuel prices. Now, when we look at consumer spending, we see that income did climb in November. A U.S. household income rose 0.3% in November. And we see the U.S. Department of Commerce telling us that, and then consumer spending also increasing with an adjusted for inflation rate of 0.3%, holding steady after October. We look at U.S. core capital good orders. They end up falling about 0.4%. This is an interesting one. U.S. home sales existing home sales plunge while new home sales are robust. Interesting, isn't it? And U.S. weekly jobs claims fall to a 42-week low again. And what happens with holiday sales? Well, they're up nearly 8%, which is good news, according to MasterCard Advisors Spending Pulse. Then we look at what's happening over in the UK. Their growth is weaker than expected. And China's modest policies are being put forward, their 2016 economic plan. Again, remember, this is a totally planned economy, so who knows where that's going to go. Brazil's anticipating further rate increases as far as their banks go. Japan's consumer prices are flat. Household spending ends up falling in Japan. That's sort of where we ended the year. So it looked like it was a decent Christmas season. Now, what do we have portending over this next week? Well, we're going to see on Tuesday the 5th, the European Union's composite PMI is going to be released. This is something to watch out for on Wednesday. Minutes from the U.S. Federal Reserve's December policy meeting are going to be released, and those can always help or hurt the market. So pay attention to that, see how that plays itself out when those numbers, those notes are released into the market. And then we see on the 7th, that's Thursday, the European Union producer price index is going to be reported. And then lastly, on Friday, our U.S. employment's going to be reported on the 8th, Friday the 8th. So again, pay attention to the employment numbers, pay attention to the Federal Reserve information. The other things may or may not have any big impact. We're going to continue to do what? Pay attention to the charts, because the charts tell you what's actually going on in the market in the past, and the kind of indicators that we use, particularly the MACD and the derivative oscillator along with it, but particularly the MACD and the kind of candlesticks that we use, give us a really good feel for where the market has been and where it may be going. That's what we rely on. Now, hopefully you've enjoyed this broadcast. We appreciate you joining us every day. If you don't have our 15-minute How to Read a Stock Chart video, you need it. You can get it for free. Additionally, you can also get our charting layout that we use at freestockcharts.com. How do you get that? Well, you just go to chartingwealth.com. You sign up for our free daily email, and we will send you links to the daily podcasts that we do, both the video and the audio, and we will also send you the weekly review and forecast. In addition, you'll get the charting layout and you'll get the video, How to Read a Stock Chart. So we are so happy to be into the new year. Appreciate you being with us. We love to hear from you. Follow us on Facebook, Twitter, Instagram, YouTube, you name it. We're there. We're here for you. When you need help, let us hear from you. Tell us what we're not doing for you, what we can do better. And we wish you the best and happiest and most prosperous of New Year's from chartingwealth.com. God bless.